Hey, good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Thursday, February 2nd, and we'll just jump right into it. The big news will actually be tomorrow, Friday, being that we had the job numbers coming out. So we'll start off today with the weekly jobless claims. Uh, last week was reported at 379 people applying for unemployment. We figured that would drop down a little bit to about 370. It actually came in a little bit lower, so that's pretty good news right there. Still high, but it's still better than what the expectations came in. And now this, of course, we're always doing in arrears, so this is actually for last week's numbers. Next item to note is productivity for the fourth quarter. Third quarter was up at 1.9%. We figured it dropped down a little bit in the fourth quarter, down to 0.6, and it came in 0.7, so a little bit better than we had forecasted originally. So again, decent numbers there. And then we got unit labor costs for fourth quarter. It was actually negative in the third quarter. We figured it would go up about 0.8% and went up about 1.2%. So costs went up a little bit more than anticipated on the labor side of things. But as we saw, people are getting paid a little bit more, so that might be involved with that as well. So incomes were up a little bit. So let's jump over to headline news here. Again, we don't got a whole lot here today, but stock market's a little mixed. The Dow was down, whereas a little bit, and the S&P and Nasdaq were up a little bit. And then right now, today, Bernanke is going before Congress, kind of urging them to create a long-term plan for deficit reduction, which will be important, especially when we're seeing what's going on in Europe. It's better to get this done now and be proactive about it, so that way we can calm any fears about investors buying our debt, for example. And obviously, we obviously need to reduce our deficit as well. We can't sit there pointing fingers at everybody else and not expect the same from ourselves. Get out of that hypocritical mode. So, with that in mind, we're going to jump over to the interest rates, see where interest rates are moving. Bond market, we had another up. Another opening gap. And right now we're actually in the 104 range on the 3.5% coupon. And so we're at a very high range. So rates are improving right now. Again, I don't know how long this is going to last. As tomorrow, if we have decent job numbers, that could quickly change. And that could drop us down back to around the low 103 level where we started last Thursday with the opening gaps. So we could drop down quite a bit, about maybe anywhere between 60, 70 basis points. So I would be very cautious in this level. We are becoming more of an overbought position. But right now, interest rates are good. If you're buying right now, or if you're in the process of needing to lock in an interest rates, I would highly recommend locking in as soon as possible. So jump into it. Also, to note on those G fees, I'm not sure if you guys are aware of those, but a lot of investors are pricing those in. And the G fees, primarily because they have a lot of people lenders are having a hard time closing within a 30-day period. So, and by law, this has to be done. They're going to start charging the Fannie Mae and Freddie Mac are going to be charging April 1st. So by the time they close a loan, originally close it, has to have those fees involved with it before they'll buy them as of April 1st. So this is one of the reasons that you're going to see interest rates rise a little bit around now. And this could happen anytime. People will probably start to implement these fees in there, and they can basically what that will do will probably raise at least 1/8% of the interest rate. So give you kind of a gauge as to what's going on there. And this new tax that the government's doing, called the G fees, will be in place till 2021. So, and this is used as a tax to help cover the expenses for the Social Security, or not Social Security, but for those who are on unemployment. So I'd love to hear from you guys' ideas on these G fees. So if you leave a comment below, I'd love to hear what you guys think about those. Taxing the new mortgages, or my idea is, why don't you go after the people who are outsourcing jobs to begin with? Why put a tax on those? So anyways, tell me what your thoughts are. Love to hear from you. You guys have a wonderful day. Catch you tomorrow.